So hi everyone, this is Mayank Kothari and today we are going to revise the entire chapter of foreign exchange and risk management. Before starting the revision, before starting the first concept, let me clear a couple of things. How we are going to revise this entire chapter. We have spent around 38 to 40 hours learning this chapter with the concepts and around 90 questions. We have discussed some concept in detail. I have dictated couple of things. I have asked you to write down it in your notes. So I'm going to take you through those notes also through the revision. But majorly we are going to revise through the summary of entire chapter because this is very important for you for all the subjects and all the chapters. Once you complete the chapter through the regular material or main material which is of like hundreds of pages and around 90 question 100 questions, it is very important that you have the summary of that entire chapter because just before a day of exam you are not supposed to revise all the chapter or the concept through hundreds of pages and those 100 questions. You should have something which will help you to revise the entire chapter through something which is very small, which can be useful to complete the chapter in just half an hour. So just imagine completing all the concepts in half an hour which we learned in the entire 38 to 40 hours. Okay, so this is where the charts plays the important role. The chart, or we can call it as a summary of the chapter. So I'm going to take you through this entire chart. I'm going to discuss each and every concept with you. Wherever needed, I'm going to write down in a separate note, or I will take you through those notes that we discussed in the normal lecture. Have a look. So this is the basics. We first started with the basics of Forex, and that is the most important part. You might have learned by now that without the basics, people will find it very difficult to solve the questions of foreign exchange and risk management. So please understand, this is the most important part. Basics. First of all, the first concept is the exchange rate. Everyone knows that exchange rate is the rate at which one currency can be converted into another currency. The second part is base currency and counter currency. So whenever I write USD INR 68.90 or GBP INR 68.90, you understand that this is a form of ISO code. This is a standardized form in which the currencies, the exchange rates are quoted, in which this first three letters is termed as a base currency, US dollar. Then the next three letters represents the price currency, and 68.90 is the price currency for every unit of base currency. How we are supposed to read this exchange rate? From right to left. So 68.90 rupees per dollar. When it is written in ISO code, we have to read it from right to left. But when it is given in terms of symbol, because in the exam you may find it that lots of questions are there in symbolic form. So at that time it will be written like this: rupees per dollar 68.90. So understand the difference between these two. Both has same meaning, but the way we interpret is different. ISO standardized ISO code is read from right to left, whereas the symbolic form codes has to be read from left to right. So this is rupees per dollar 68.90. So what is the currency of 68.90? Price currency, which is rupees here. What is the currency of 68.90? Price currency, which is rupees here. There is no difference in both the codes. It has one and the same meaning. It will be used in the same manner, okay, in every question. It's just the way it is presented. So you understood about the price currency, base currency. Now let's talk about bid and ask. What is bid? Bid is the bank's buying rate and ask is the bank's selling rate. But lots of students makes mistake here. They don't understand that bid is the bank's buying rate for the base currency. They don't understand that banks ask is the bank's selling rate for base currency. So before, if you don't want to make mistakes in exam or in any question, so before picking up bid or ask, make sure that you understand what is the base currency in any quote, first of all. And bid and ask has to be interpreted in the form of base currency. Doesn't matter what your requirement is. You want to sell pounds, you want to sell INR, you want to sell dollars, doesn't matter. Convert your requirement into the base currency. So suppose I want to sell rupees. I as a customer wants to sell rupees. I have been given this quote where I understand that US dollar is the base currency. My requirement is to sell rupees. Base currency is dollar. My requirement is not in dollars. I have to convert my requirement first in the base currency. So if I want to sell rupees, I want to buy dollars. Now if I want to buy dollars, bank will sell dollars and hence the ask rate will be applicable 68.95. Every time make sure that your requirement is in the terms of base currency. If it is already there, then the question is very simple. If it's not there, convert your requirement. If you want to sell rupees, that means you want to buy dollars. If you want to buy dollars, the base currency is dollar, ask rate is applicable. Okay, so another thing is, one thing that we have to remember is always interpret in terms of base currency. Next thing, always interpret these rates from the angle of the bank. From the angle of the bank. Now, if these are interbank rates, one thing you need to understand. If you have been given with interbank rates, and this is, let's say USD INR 7072. Okay, if you want that you should not make mistake, even a single % mistake should not be there, then please understand so if the interbank rates are given and you are the bank, you are the main bank, okay, if you have to interpret, if you have to apply these rates to the customer, if the rates has to be applied to the customer, then interpret these rates from your angle. If you are dealing with these rates, if you are dealing with other bank, that means if you are dealing in interbank, then interpret those rates from other bank's angle. So the same rate, what I'm asking is, same rate has to be interpreted from this angle also, same rate. What is most important is with whom you are dealing. If you are dealing with another bank, interpret those rates from another bank's angle. If you are dealing with the customer, interpret those rates from your own angle. So let's take a couple of examples. You want to, as a bank, you want to sell dollars. That is not sufficient enough to interpret the rates. It should be clear that to whom you want to sell dollars. If you want to sell dollars to the customer, ask rate is applicable, because we will interpret these rates from our own angle. I want to sell, selling rate is ask, apply this. If I want to sell dollars to the other bank, bid rate will be applicable. Why? Because now it will be assumed that these rates have been quoted by this bank to us. So I want to sell dollar, this bank will buy dollars. This bank will buy dollars, and hence bid rate is applicable. Are you getting it? So Do you understand the difference? Why student makes mistake is because of this reason. Sell dollar, ask rate, that's it, finish. They don't understand that this bank is selling the dollars to this bank and the rates have to be interpreted from this bank's angle. And this bank is buying dollars, not selling dollars. So sell dollars to customer, ask rate. Sell dollars to this bank means bank is buying dollar, this bank is buying dollars, and hence bid rate. Do you understand that? And before picking up all these rates, you need to make sure that the base currency here and the requirement here is same. Your requirement should be in base currency before doing all these things. So yes, it is complicated and couple of things has to be remembered, but I ensure you this, that you will not make mistake if you go by this way. You need to understand one thing, that bank always buy cheaper and sell higher. Buying rate should always be smaller than selling rate. Next comes the direct and indirect quote. Direct quote and indirect quote. What is the most important part while interpreting the direct and indirect quote? Which is my home country and which country is my foreign country? Home country or domestic country, we can call it anything. And the second thing is foreign country. So if we do not understand, if we do not have this data given in the question, it will be very difficult to find out which is direct quote and indirect quote. So direct quote is something which is given as home currency per unit of foreign currency. Okay. But indirect quote is something which is foreign currency per unit of home currency. So let's dig into it. This is the quotation given to you. Let's assume USD INR 68.9095. So tell me how the student makes mistake. I'm going to tell you. USD INR 68.9095. This is a direct quote or indirect quote? Do you think this much data is enough to interpret if this is a direct quote or indirect quote? Lots of students interpret this as a direct quote. How come this is a direct quote when I have not told you that your home country is India or your home country is America? If your home country is India, this is a direct quote for you because INR is your home currency. This is your price currency. And at that time, see, if you are from India, then this rate becomes, then can I say that USD is my foreign currency and then INR is my home currency? So I can write it like this, 68.9095. How to interpret this? Because it is in ISO form, it should be from right to left. 68.90 home currency per unit of foreign currency. So home currency per unit of foreign currency is a direct quote. But this is possible only when you know that you are from India. But if I say that you are from America, then USD is your home currency. USD is your home currency, INR is your foreign currency, 68.9095. Since it is in ISO form, it has to be read from right to left. So 68.90 foreign currency per unit of home currency, 68.90 foreign currency per unit of home currency. So this quotation is foreign currency per unit of home currency. This is indirect quote for me. So understand the difference, that the same rate, the same quote can be direct for someone and indirect for someone. So it is very important before concluding that it is direct quote or indirect quote. It is most important that we understand that are we from India or we are from US. One thing, okay. There are lots of questions in which we have to find out whether this quote is direct or indirect. And it is not clear in the question that we are from India or we are from US. At that time, what should we do? When nothing is given in question, please understand, when nothing is given in question, assume the quotation given as a direct quote. Accordingly, India will become your home country, US will become your foreign country. Assume it as a direct quote and then solve the question. Answer will not change at any cost, even if you assume it as indirect quote. Okay. Calculation will change, but the final answer will be same. So if you have an option to assume it as a direct quote or indirect quote, you tell me. To simplify the calculation, isn't it good that we assume this as a direct quote? That's why I'm telling you that assume, when nothing is given, assume it as a direct quote. Another thing, there is a relationship between a direct quote and indirect quote, where direct quote is inversely related to indirect quote. Direct quote is equal to 1 divided by indirect quote. And the same applies to bid and ask. Bid of the direct quote is equal to 1 by ask of the indirect quote, and ask of the direct quote is equal to 1 by bid of the indirect quote. Why? Because the banks always buy cheaper and banks always sell higher at a cost. So when you convert the bid of direct quote, it becomes the higher value of indirect quote, and that's why we put it in ask side. So bid of the direct quote can be converted into indirect quote, but it will become ask. Ask of the direct quote can be converted into indirect quote, but it will become bid of that quote. This is the most important part. This is useful in cross rate calculation. I think only there this is useful. Cross rate calculation. There are a couple of more questions also, but most of the time this will be useful in cross rate calculation. Then comes the spot rate and forward rate. You understand the meaning of spot rate and forward rate? Spot rate is the rate at which, just a second. Spot rate is a rate at which one currency can be converted into another currency today itself at time 0. Theoretically speaking, it takes 2 days. See, if you enter into a contract with bank, they will deliver you the currency after 2 days or after tomorrow. That is also covered in spot only. Then comes the forward rate. If you want to sell or buy foreign currency after 3 months or 2 months, and you want to fix the rate today of that transaction, then forward rate is applicable. Forward rate is available from the banks. You can go to the bank and tell them that after 3 months you are going to sell this currency, tell me the rate today. And why you are going to do this? Because you don't want an unfavorable spot rate on that date. You don't want to take the risk of unfavorable spot rate on that date, and that's why you fix the exchange rate by entering into a forward contract with the bank. Next comes the spread and swap. This is the most important part, one of the most important part. So let's take the spot rate of USD INR, or you can say rupees per dollar. In symbol it is like this, in ISO form it is like this. So spot rate of 65.4025, 65.4250 bid and ask. Forward rate of this bid and ask. Now the difference between bid and ask is called as spread point. This is the profit of the bank in buying $1 and selling that dollar to the customer. So bank will buy $1 from the customer at this rate and sell that $1 to some other customer at this rate. And the difference will be the profit of the bank, because bank is there to do the business of currency. They will earn something. So that 225 points are the spread points. The difference between the forward bid and forward ask is also the spread point. It doesn't matter whether it is a spot rate or forward rate. The difference between bid and ask is called as spread points. Now the difference between spot and forward, the difference between spot and forward is called as the swap points, or in another words it is called as forward margin. 75, 125. The difference between these two. Getting it? Now please understand whether this is a swap point or a spread points. It has to be applicable. It has to be added from the last digits of the bid and ask. So these 75 will take place on the last 2 digits or last two digits, or if you call them, if you take two spread points, then this will be applicable in the last three digits or last three digits. It starts from the last to first. Always remember this. So if I want to add to 25 points in this 65.4025, I will write down 65.4025 plus 0.0225, last three digits. Remember? Then comes the American and European quote. Now, what is American quote and European quote? This is just for the purpose of understanding. The rates quoted in amounts of dollar per unit of foreign currency. It means wherever the dollar is price currency. This is base, this is price, or you can say counter. When the dollar is price currency, US dollar, it is called as American quote because it is in the form of American. When INR is the price currency, we call it as Indian quote. Similarly, American quote is where dollar, US dollar is the price currency. But from the angle of America, when the dollar is base currency, when dollar becomes base currency, then it is called as European quote. Foreign currency per unit of dollar. So if I'm American, INR is my foreign currency per unit of home currency. So this foreign currency per unit of dollar is European quote. One thing that you need to understand is here dollar should be there. If you take GBP INR, it is neither American quote nor European quote. For American point of view, dollar should be the price currency in American quote and dollar should be the base currency in European quote. Okay, so let's move on. So let's have a look on another concept, that is cross rates. This is the most important part where you understand that this formula which we learned in the school days is applicable here. A by C is equal to A by B into B by C. So if you write it in this manner, or I will suggest you to update yourself and use this format. This is the best one. If you want to find out bid of GBP INR, first of all create your requirement. Do you want bid of GBP INR, or you can also take ask of INR GBP. Both will have the same answer. Bid of GBP INR or ask of INR GBP, both will have the same answer. So don't ask, sir, whether we can take bid of this or ask of this. You can take it easily, but depending upon your requirement, the equation will change. Okay, so if I take the first one, please remember, if the left hand side is bid, everything on the right hand side should be bid. One rule. Okay, the first rule. Then second is, if GBP is written first here, GBP should be first, and INR is written last here, INR should be last. So just check it. This is bid of GBP. Let's say the third currency is USD. So I will take USD multiplied by bid of, which should be the first currency, USD, because I need to cancel USD INR. What will happen, this USD and this USD will get cancelled. What will be left is the GBP and then INR. That is what I want. But if I want to create equation for this ask of INR GBP, then I will write down ask of INR first and then USD multiplied by ask of USD first and then GBP, so that the first currency left here is INR and the last currency left there is GBP. USD gets cancelled. Both the equation will give you the same answer. Now after creating the equation, look at the question. The very first thing that you need to clarify is whether the rates given are GBP USD there and USD INR. Let's say this equation has been taken, or let's take this one, ask. So find out in the question whether the quotation are given in the form of INR USD and USD GBP. Let's assume that this INR USD is given in the question as we need it. So requirement is equal to what is given in the question, but USD GBP is not given. In question it is GBP USD. So if this is the direct quote, indirect is given. If this is indirect, direct is given. That is what I will conclude. Okay, if GBP USD is given in that question, let's say the given data is GBP USD. So you need ask of USD GBP. Can you take ask of GBP USD in place? No, sir. So convert your requirement into what is given in the question. The next step will be ask of INR USD, because it is given directly. I can take the rate, and I want to convert direct from indirect or indirect from direct. Whenever we do that, ask becomes bid and bid becomes ask. So I will write down 1 divided by bid of GBP USD. So what I have done is, now I have a requirement in the same way the quotations are given in the question, and now pick up the rates from there. Take the ask of INR USD, you can take it from question, take the bid of GBP USD, and then you can solve it. Simple thing. So summarizing the steps, whenever you need to find out the cross rates, make sure that if first thing is you can take bid of this and ask of this, anything, the answer will be same. So whatever you do, you need to make sure that if your requirement is bid, the equation on the right hand side should also be bid. And then next thing is GBP should be first, INR should be last, and in between you have to fix the third currency, US dollars. So you can do that. Then comes the requirement. You need to find out whether GBP USD is given in question or not. USD INR is given in question or not. If it is given, the calculation is easy. If it is not given, you need to convert your requirement into what is given in the question. This way you will never make a mistake. Okay. What if, sir, 4 currencies are there? Let's say we need bid of GBP INR and 4 currencies are there. Then I can frame it like this: bid of GBP USD, then bid of USD. Always, if USD is written last year, it should be first in the very next part, because only then we can cancel it. USD, let's say Japanese yen. And then multiplied by bid of Japanese yen INR. So see, USD is last year, first year will get cancelled. JPY is last year, first year will get cancelled. What is left is GBP and INR. GBP and INR. It's easy. It's not difficult. So first thing is to frame an equation according to the requirement. Second step is to find out if the codes are really in this ISO form. If it is not, convert your requirement in what is given in the question, and then take the rates. So this is the cross rates, and then comes the premium and discount. You learned about this. Now what matters, let's take an example of USD INR 50 today and 52 tomorrow. Here the base currency is US dollar. So if you want to calculate premium or discount, the formula goes to 52 minus 50. This is how much dollar is appreciated, and the base is 50. So it is 2 divided by 50. That's around 1%, sorry, 4%. Okay. This is a positive figure. That means the dollar is appreciating, the base currency is appreciating. And what is the formula? 52 was forward rate, 50 was spot rate, divided by spot rate. That's it. If this is for 3 months and you want to convert it for 12 months, then you will have to add couple of more things. So tell this equation that you are for 3 months and I want an answer. You are for 3 months and I want an answer for 12 months. So 12 by 3 will be the answer, multiplied by 100 to convert it into percentage. But at the same time, if the quotation is given like this, okay, and you have been asked to calculate the premium or discount not in dollars but in INR, not in dollars but in INR, then what will you do? The same formula will not be applicable. Then at that time the formula will be different, which is S minus F divided by F. And you will ask that why, sir, the base has changed. The Y base has changed. First of all, let's find out the answer from this equation. S is 50 minus 52 divided by 52. Then you will realize see 50 minus 52 divided by 52, that goes to negative 3.85%. So I can say that INR in the same quotation, dollar was appreciating by 4% and INR is depreciating by 3.85%. So one thing is clear, appreciation in dollar doesn't mean the same figure will be there in depreciation in rupees. So appreciation in dollar is not equal to depreciation in rupees. First thing. Second thing, sir, why you have changed the formula? We can keep the same formula for both. But make sure in whichever currency you are calculating the premium or discount, it should be the base currency. And if it is not the base currency, convert the quotation in such a way that it becomes the base currency and the answer will be same. So one way, first way to calculate premium or discount in USD means the base currency, use this formula, and price currency, use this formula. This is one option with you. Otherwise, for base currency though it is same. If you want to keep the formula same for the price, for the INR also, then convert USD INR into indirect quote and you will get the logic. So 1 by 50 and 1 by 52 will be the answer. If I write it here, INR USD 1 by 50 and 1 by 52, if I convert direct to indirect, it becomes like this, and INR USD will be 0.02 0.019231. I am taking so much figures because I don't want any, I want minimum rounding of differences. So here you will realize that the base currency is INR, and now apply the same formula. At this time you need to remember only one formula, F minus S divided by S, or you can take it like this, F by S minus 1, because S is the common base for both. So F by S minus S by S, and S by S becomes 1. So you can use that one also. Let's use it and find out what is the answer. Forward rate is 0.019231 divided by 0.02 minus 1, and your answer will be minus 3.85%. So your doubt is cleared that we can use the same formula for dollar also, for INR also, and you will get the same answer, 3.85. But if you want to use the same formula, make sure the INR, the currency for which you are applying the formula, is a base currency. Here dollar was base currency, hence this formula is applied. Here INR is the base currency, hence this formula is applied. My suggestion is not to do direct to indirect rates, because it will leave error for rounding off. Instead of this, follow the simple rule. Keep the quotation given as it is, USD INR 5052. Do not change the question, and then find out the requirement. You want to calculate premium or discount in base currency or price currency. If base currency is there, F minus S by S. If price currency is there, S minus F by F. That's it. Only two formulas has to be remembered, and answer will be same. See, using this formula, the answer is still same. Okay, so this was all about premium and discount. Alright, F is in the denominator, it is the formula for base currency, F by S. or S by F minus 1 is the formula for counter currency, or we can call it as a price currency. Then comes the pips. What is pips? Price interest point. This is the smallest unit by which an exchange rate changes. It is the smallest unit by which a currency quotation can change. USD INR quoted to a customer is INR 61.75. So if it is given 75, what can be the next rate? 61.76, 77, 78, 79. So that point 01 is the smallest change, and this 1 is called as pip. So if I say that, just imagine, if I say that this spot rate will change by 6 pip points, 6 pips. In the forward market, it is changing by 6 pips. How are you going to calculate the forward rate? Normally 61.75, and you will add 6 in the last digit, it will become 81. This is the new forward rate. Okay, so the minimum value this rate can change is either 61.74 if you go down, 61.76 if you go up. In other words, USD INR code, the pip value is 0.01. However, in Indian interbank market, USD INR rate is quoted up to 4 decimals. Hence, the pip will be, the minimum value it will change is 0.0001. When we calculate, when we say pip, here it means 1 only. This is 1, this is also 1, but it is in 4 decimals, so 0.0001. If I say 12, it means 0.0012. In Indian market, it is like that. Then comes the merchant rate and interbank rate. Very important to understand. The quotations given to you may be merchant rates or may be interbank rates. But what happens in the normal market? This is our bank. And this bank deals with the customer directly and other banks also. It's just like a mother dairy shop, you can say. A mother dairy shop in your colony. What happens with the mother dairy shop? They buy the milk and the other products from the parent company. So this is mother dairy, this is also mother dairy, but this is a branch of the mother dairy, franchisee of the mother dairy. This is the holding company, or we can say the main company. Both of them are mother dairy. So here also both of them are bank, but they are dealing with each other. And why this mother dairy is buying milk from this? Because this mother dairy has to sell that milk to the customer. So this is a wholesale market, this is a retail market. Now what happens is, in a normal life, this mother dairy branch buys a packet of milk at 18 rupees, add the profit for them, and then quote 20 rupees to the customer. So this 2 rupees becomes the profit of the mother dairy franchisee, because that company, that branch also wants to earn. In the same way, what happens is, let's say if dollar has to be purchased by the customer, so this bank will buy the dollar in the interbank market, and the interbank rate is, let's say, 70 rupees per dollar. The same rate will not be quoted to the customer. The margin will be added in that. So it will become 70 plus 2, then 72. So the rate quoted to the customer will be 72. So there will be 2 rates given in the question, 2 types of rates given in the question. Either it can be interbank rates or it can be merchant rates. My question is, in which rate margin should be adjusted? Margin should be adjusted in interbank rates. Then it becomes merchant rate. So interbank rate plus margin is equal to merchant rate. So if you have the chart ready, please write down plus minus margin. Plus below that write down margin. Why? Because let's take an example. So a lot of people have confusion why we add margin in ask and why we deduct margin from bid. Okay, so let's say the rates given to us are interbank rates. Okay, USD INR 70, 72. What does that mean? These are interbank rate. This is our bank, this is customer, and this is other bank. I already told you in the beginning that if you have to interpret this rate from our like while applying to the customer, then think from our bank's angle. If you are applying this rate, the same rate for a transaction between these two banks, then apply the rate from other bank's angle. Okay, let's have a look. Now what is happening here? Let's say margin, I'm not taking the margin in percentage, I will take the margin as 2 and 3 rupees directly to keep it simple. Okay, so what is the normal transaction? Let's take 70 rupees. What is 70? This bank and this bank, when dealing with these two banks, the rates has to be interpreted from this bank's angle. Okay, it means at 70 rupees this bank will buy dollars from this bank. Bid rate, that is a bid rate, means bank's buying rate. Which bank's buying rate? This bank's buying rate. So this bank will buy dollar, let's say $1, and this bank will pay how much rupees? 70 rupees. When do you think this bank will buy dollar? When this customer will be selling dollar to our bank. We will sell that dollar to the other bank. We don't want any kind of exchange rate risk. Now you tell me, how does this sounds to you? I as a bank bought $1 from the customer at rupees 70. So I paid 70 to him and I received 70 from the interbank also. How does this sounds? What is the profit of our bank? Nothing, zero. Because I received 70, I paid 70. Why I will do such transactions when I have no profit in that? Obviously. So at that time, what will happen? What will happen? Since I'm receiving 70, and I have to make a payment to the customer. If I have to make a payment in rupees, you can clearly see the rupee is flowing out, but the margin is always a profit of the bank. Margin should come in. Rupees is going out. So margin is cash inflow. This bid rate is cash outflow. So at that time, what will happen? 70 minus 2. I will apply 68 rupees. So does this sound good to you? I received 70 and paid 68 for the same. So what is my profit? What I have kept with me? 2 rupees. Okay. Even if you don't understand, just keep 2 here and understand this. Don't you think the bank will keep 2 rupees as a profit? Bank will keep 2 rupees as a profit. So whether we should deduct or add 2 rupees, the question is this. If we add 2 rupees, that means we are receiving 70 and paying 72. Is it going to happen? Bank is going to pay more. It will be at loss if it does that. So the bid rate, from the bid rate, the margin is always deducted. Okay, let's take another example of ask, and then you will understand why we add. So 72 is the rate at which this bank will sell dollar to this bank and this bank will sell dollar to this bank. That means 72 is applicable for him while selling to this, and the same 72 is applicable for him while selling to the customer. So dollar is going out and rupees, so from our angle dollar is coming in and rupees is going out, that is we are paying 72 rupees. Here the dollar is going out and the rupees is an inflow. Now you decide, this is customer, this is our bank, this is other bank. Now you decide and tell me, do you think I am going to, how much is the margin for ask? 3 rupees. So what do you think is going to happen? 72 minus 3 means what? 69. So do you think this is going to happen? I will receive 69 and I will pay 72 to the other bank for the same dollar? No, this is not going to happen. So deducting 3 rupees from 72 is not an answer. How about adding 72? If we add 72, that means I have received 75 from the customer, kept 3 rupees in my wallet, pocket, and then paid 72 to the other bank. So this sounds good. I have margin with me. In both the cases, the margin will be kept by the bank. Because this 72 is going out of the bank, margin should come in. That's why 2 rupees is deducted from the bid. But in this case, margin should also come in. The 72 should also come in. That's why we added 73 rupees in 72. So the question is simple: ask plus margin. Ultimately, the conclusion is, from bid you should deduct margin, from ask you should add margin. Let's come over to the main topic now. Then comes the broken period forward rate. This is very easy to understand. Very easy to understand. Let's say, for example, you have been given spot rate of 72. Okay. You have been given forward points of, let's say, 50. 2 months forward. This is 1 month, this is 2 months, this is 3 months. And you have also been given 3 months forward as 70, or let's say 80. So if you want to calculate 2 months, let's take this rate as 70.20, only one rate. Let's keep it to one rate only for the purpose of understanding. So it's 70.20 and the 2 months forward rate points are 50. How do you calculate 2 months forward rate? You add those points, because you will add these points 70.70 in last 2 digits. And if you add here, it will become 71.00. So this is how we calculate the forward rate. We add those swap points in the spot rate. But 70.70 is applicable when the question asks you to calculate 2 months forward rate. And 71 is applicable when the question asks you to calculate 3 months forward rate. What if the question asks you to calculate 2 months 10 days forward rate? How are you going to do that? It's not even 2 months, it's not even 3 months. 2 months 10 days. When they ask you a date, because the customer needs to make a payment on 2 months or 10 days, so we need to give them a rate. When the customer does that, the bank will have to find out a broken period forward rate. Now the period has been broken. It's not even 2 months, it's not even 3 months, it's somewhere between these two. So whenever this happens, first of all, calculate that for shifting from 2 months to 3 months, you can see the bank has added 30 more points, right? These 30 more points have been added for 1 month. That is 30 days. So can I say that 30 points divided by 30 days becomes 1 point per day? It means bank has added 1 point per day, and I want only 10 days extra. After 2 months, I want only 10 days. So multiplied by 10, that means I just have to add 10 points. Just a second, okay. So 10 points extra should be added in 2 months. So it becomes 50 plus 10, 60. Is it difficult? This is called as interpolation. Okay, this is how you have to calculate the broken period forward rate. Now 60 is there, plus 70.20, it becomes 70.80. That's your final rate of 2 month 10 days. So can we calculate for any date? We can calculate the forward rate. It's just the interpolation that you have to do. So that's how the broken period forward rate is calculated. You can go through this one. This is a complicated, it covers almost every scenario. So understand this. Please understand that 133 and 140 is in ascending order. This is something that I have not explained to you. 75, 125 is in ascending order. That means we need to add this point in spot rate. If it would have been in descending order, we would have deducted these points from the spot rate to arrive at forward rate. Same thing will happen here. See, 133, 140 is in ascending order. That's why we are going to add here. It is in ascending order. See, 145, 155. That's why we are adding those points in spot rate. But if it is in descending order, 175, 155, 160, 145, we need to deduct in order to calculate forward rate. That's it. So this was all about the basics. Now comes the theories in Forex. The most important theory in Forex is interest rate parity theory. It says that the difference in interest rate of two countries should be compensated by the difference in the exchange rate, spot and forward exchange rate between these two countries. So the basic formula is 1 plus rate of domestic country divided by 1 plus rate of foreign country is equal to forward divided by spot, when the quotation is direct. But if it is indirect, there are certain changes that you need to make to the formula, just to make sure to avoid mistake. When the quotation is indirect, instead of putting RD in the numerator, put RF in the numerator and RD in the denominator. That's it. Just change the formula. Or else you can keep this side same or put S in the numerator, F in the denominator. The answer will be correct. Now what is this formula? This says that the difference between rate of domestic countries and foreign countries should be equal to the difference between spot and forward exchange rate. The difference between spot and forward exchange rate is called as interest rate differential. And if this happens, if this theory holds true, arbitrage opportunity does not exist. Before moving forward, I will explain the purchasing power parity theory, as this purchasing power parity theory is similar to interest rate parity theory. Instead of interest rate, you use inflation rate here. Inflation in domestic country, inflation in foreign country. If it is indirect quote, put inflation in foreign country in the numerator and domestic country in the denominator. Okay. Purchasing power. International Fisher effect explains the relationship between real rate and nominal rate. So what is the formula for that? 1 plus nominal rate in bracket is equal to 1 plus real rate in bracket 1 plus inflation rate. This is the formula. Unless otherwise given, all the rates in the question will be treated as nominal rate. Okay, now let's come to the arbitrage using interest rate parity theory. There are two things that you need to understand when you talk about arbitrage using interest rate parity theory. Just give me a second. I will find out that question, that topic. Where we have written every damn thing about interest rate differential. I think we had prepared a separate note for this. This is interest rate parity theory. Have a look. You need to remember ultimately only two things. This, according to interest rate parity theory, high interest rate currency should depreciate and low interest rate currency should appreciate. Invest in high interest rate currency until it depreciates by the interest rate differential. Borrow in low interest rate currency until it appreciates by interest rate differential. So whenever you want to find out in which currency I should invest, in which currency I should borrow, you need to first find out this. Take any rate, high interest rate or low interest rate. If it is a high interest rate, by default it means you should invest in that until this currency depreciates by this much amount, interest rate differential, whatever the difference between two interest rate is. By this much amount the interest rate should depreciate, and until then you have to invest in high interest rate. So this word until is very important, because beyond this, if the high interest rate currency is depreciating, beyond this you will start borrowing instead of investing in this by default. So let's take for example 4% is the difference between two interest rate. So it can be 10 minus 6, 4%. So logically speaking, low interest rate currency should appreciate or be at a premium by 4%. So if it is from this point to this point, we will borrow in dollar until it appreciates by 4%. If it appreciates beyond that, we will start investing in dollars. But until then, we will borrow. No matter it is a discount, premium, zero, whatever it is, 4% premium. Or in another way, we can say that if you talk about this rupees, it should depreciate by 4%. It should depreciate by 4%, and until then we should invest in high interest rate currency. That's it. So first of all, you need to understand high interest rate currency should depreciate, and it should depreciate by an amount equal to interest rate differential. Low interest rate currency should appreciate, and it should appreciate by an amount equal to interest rate differential. But when this depreciation and appreciation is these two currencies goes beyond interest rate differential, we will start doing the opposite. Borrow in high and invest in low interest rate. Otherwise, the normal thing. So that those two sentences matters a lot. Or you can remember it in this form also. Then comes your exposure in Forex. There are three types of exposures in Forex: foreign exchange and risk management. So first is transaction exposure, which explains the difference between what if the profit would have been if the transaction would have been settled here, and what is the profit if the transaction is settled after 6 months. So the difference between these two dates is two different exchange rate, and because of those two different exchange rate, we will ultimately end up with profit or loss. That will be called as transaction exposure. Translation exposure is something related to your financial reporting subject, is not in this SFM. It is like converting the closing balances of balance sheet at a closing rate and converting the profit and loss account item at an average rate. And because of this, certain profit or loss will be there due to exchange rate fluctuation, and that will be called as translation exposure. Then comes economic exposure, or we can say business exposure or operating exposure. Economic, business, operating, whatever it is. It considers all types of risk. Even the transaction risk is also included in economic exposure. This says overall impact. So profit or loss due to difference between two dates, profit or loss due to increase or decrease in demand. If you remember, there was one question, because of the change in spot rate, the demand increased by 17 units, and that's why we had a profit of business exposure. Then comes the management of this risk, transaction, translation, or operating. We need to manage it on a continuous basis. Management of forex, management of exchange rate fluctuation means hedging, avoiding the risk, and hedging is of various types. Let's learn. The very first thing is, if you have a exposure, if you have some foreign currency payable or receivable, that means you have exposure, and you need to decide at that time whether you want to hedge or you don't want to hedge. If you don't want to hedge, that means you are keeping the position open, and at expiry you will convert those receivable and payable at the given spot rate. That may lead to some profit or loss, but you are keeping the position open. If you expect that the situation will be favorable on that date, then only you should not hedge. If you have this fear of unfavorable spot rate on that date, then it's better not to wait but to hedge today itself that exposure. And when it comes to hedging, there are two different types of hedging: internal hedging and external hedging. Internal hedging has some parts, external hedging has some part. Let's first discuss about internal hedging. The very first part in internal hedging is home currency invoicing. Internal hedging means deciding something inside the company, not taking the help of others, but deciding something inside the companies, making such policies so that internally we can reduce the risk. External hedging means taking the help of outside organization. So home currency invoicing, if an American comes to you, a party comes to you and wants to buy some goods that you are selling, and he wants a bill in dollar, but you are like, I will give you the bill or the invoice in rupees only, because my policy is following home currency invoicing. When you follow home currency invoicing, that means today you make a bill of, let's say, 1 lakh rupees. So if he pays today, he have to pay 1 lakh rupees. If he pays tomorrow, he have to pay 1 lakh rupees. So there is no profit, no loss, no exchange rate fluctuation to you. Okay, but that leads to the risk of losing customer may not like this, and customer will be like, okay, don't invoice me in dollar, I will go to some other vendor and I will buy it from him. And this is not a good idea. Just because of home currency invoicing policy, you cannot lose the customer. Then comes leading and lagging. Leading means settling the transaction before due date. It is payable or receivable, whatever it is. If you think before due date the prices, the exchange rate will be favorable, you can settle it before due date. If you think after due date the exchange rate will be favorable, then you can ask for lagging the receivable. It means settling the transaction after due date, after few days, let's say 1 month or 2 months after due date. Now there have been some questions that we solved on leading and lagging. One thing that you should note in all the types of question, whether you lead or whether you lag, the decision should be made based on the cash flows in both the option on same date. So if it's a 2-3 months question and you have to lead at 2 months, so do the leading part, but take that cash flow till the end of 3 months. So add or less interest in that, add interest in that, and it becomes the 3 months cash flow. So one option will be whether we should lead, whether we should not lead, the other option. In both the option, find out the cash flows at the end of 3 months only, and then decide whether you have more receivable or more payable. In whichever option you feel we have more receivable or less payable, that option is preferable. Only then you will go for leading and lagging. So we have seen 4 different types: leading the receivable, leading the payables, lagging the receivable, lagging the payables. Okay. And in all those 4, where do you think the discount will arise? When you would want to lag the payable, the other party will not agree and you will have to pay interest on the invoice value. When you will say lead the payable, lead or we can say leading the payable will not attract discount, but leading the receivable will attract a discount. See, if that party has to pay $1 lakh to you after 3 months and you ask him that please make a payment after 2 months now, he will not be ready, because according to the terms he should make a payment after 3 months. And if you are asking him to make a payment after 2 months only, he is losing an interest of 1 month, opportunity to keep the money with him for 1 month. So you need to provide some discount to him. So let's take 2% discount and make the payment after 2 months. And this, if is attractive offer for him, he can make the payment after 2 months. See, for him it's like paying $1 lakh at the end of 3 months or paying $98,000 at the end of 2 months. He will do his calculation, and if it is profitable to him, he will be ready to make the payment. We have to decide whether receiving 98,000 at the end of 2 months or receiving $1 lakh at the end of 3 months, which option is preferable to us. At all point of time, you need to decide based on same dates cash flow. Both the options should have the same date cash flows. Then comes the netting. You remember the netting, where first I will just give you an example of it once again. Okay, so let's imagine there is a parent company in India, and this is US and this is UK. So we have two subsidiary companies in US and UK. Okay, and there are some transaction between all these three companies during the year, in which these two parties has some payable and receivable to each other. So let's say we have to make a payment of £100 to US party, this UK company. On the other side, India has to make a payment to the UK, and let's say for the sake of simplicity we will keep it as £100 itself. And then India has to make a payment to the US also of $150. And let's take the exchange rate, rupees per dollar, rupees per pound, and one more thing, dollar per pound. Okay, we'll cover every possible situation. So let's take it as 70, 100 and 1.43. These are the rates. Let's assume, okay, don't judge on these rates and these figures. Right now, if you look at the data situation, there are three different transactions. That means India will pay to UK, then UK will pay to US, and then India will also pay to US. There are three different transactions happening through bank, and all of these transactions are crossing the borders. So therefore there will be a transaction cost. There will be exchange margin kept by the bank on this entire amount. Higher the amount payable, higher will be the margin of the bank. So internally we can do netting. Netting means reducing the transactions. Now what I can do is, in this situation, I can reduce the transaction from 2 to 1. Let's have a look how it is possible. So what I am going to do, I will ask UK not to make a payment to US. I will also not make a payment to UK. Instead, what I am going to do, okay, let's take one thing. Instead of payable, take receivable from US as $150. Okay, so I will take receivable instead of payable. I can justify the situation, that's why. Okay, so that's the normal situation. Now instead India paying to UK and then UK paying to US the same amount, what we can do is we can reduce the transaction, and now India can pay £100 to US directly. So don't you think this and this has the same result? Yes. US was supposed to receive 100 pounds, it is receiving. India was supposed to pay 100 pounds, it is paying. And in the hands of UK, nothing would have been left in this transaction also, and nothing is being left here itself. But in this entire process, we have reduced the number of transactions from 3 to 2. So less number of transaction, less transaction charge, less exchange margin to be shifted to bank. So that's a good thing. Again, we can do one more thing. Instead of these two transactions happening here, we can reduce the transaction to one. What we can do is convert these 100 pounds payable to US, because anyhow after receiving the pounds, US would have converted it to dollars. So convert these 100 pounds into dollars at the given exchange rate. Dollar pound rate is 1.43. So multiply this 100 with dollars. So what will happen? This becomes 100 multiplied by 1.43, that's $143 payable. Now you can clearly see that we have a receivable of $150, we have a payable of $143. Now why we cannot reduce the transaction to just one transaction, and that too only receivable of $7. Ultimately this is happening. Only one transaction means we have saved the transaction cost, we have saved the exchange margin, and that too the amount which is transferring from one country to another country is only $7. How much you will pay on this, the transaction charges on $7? How much will be the exchange margin payable to the bank on $7? Very less. So instead of doing all this transaction and paying hefty amount in terms of transaction cost and exchange margin to the banks, why not we convert the entire transaction just to one, from 3 to 2, 2 to 1, and then after that also the amount is only $7. This is called as netting. Internal transactions have been done, setting off has been done, and that's why we have reached this. This is how we have reduced the risk. Now whatever the exchange rate, only $7 is exposed. Earlier a lot of money was exposed because of the exchange rate changes. So this is called as netting. Then comes matching. Matching is a similar concept to netting, but it is quite different. What do you do let me first remove all those things. App Store, notes. Yeah. So what do you do in matching? What happens is, let's say this is the country. So let's imagine this is India and this is US. Party A, B, C, D. Let's say that we have a payable of $1 lakh to B because we are importer, and C has a payable here in India of around $70,000. So there will be two transactions, and these two parties doesn't know these two parties. Okay, but somehow if they get to know about each other, then they can help in reducing the transaction cost, the exchange margin for all the four people. How? See, it's very simple. Let's say rupees per dollar rate is 50. Okay. So if D receives $70,000 today, he will convert it at 50 and it will be around, I think, 3.5 lakh rupees. So D should be getting 3.5 lakh rupees after the conversion. Okay. And A is paying B in there. Can we do the transaction like this? Have a look. What I am going to do right now is, C has to make a payment to D. Okay, And what I will do is, in India, A will make a payment to D and D will ask C to make a payment to B. So first of all, the transaction is happening in their own country. How much? $70,000 and rupees 3,50,000. He was supposed to receive 3,50,000 from C. Have a look here. But now he is getting it from A. So he is happy. He doesn't need any money from C now. And C was supposed to pay $70,000 to D. Now he is paying the same amount to B. So he has no payables now. So there will be no transaction now in between these two. That means the cash flow will not transfer from one country to another country. No transaction cost on $70,000 of transferring to other country. No exchange margin on $70,000 also. Okay, this much. And when it comes to A being payable to B, A will pay only $30,000 to B. Now, from the angle of B, he was supposed to receive $1 lakh. He is receiving $1 lakh. 30 from this, 70 from this, he is receiving. A was supposed to pay $1 lakh and he is paying 3,50,000 rupees to D and paying $30,000 to B. In a term, it is $1 lakh only. If you convert this in dollar, it is $1 lakh. So what is happening? Earlier there was transaction cost on $1,70,000. There was exchange margin on $1,70,000, and that hefty amount we brought down that hefty amount to $30,000 only. That's it. This is called as matching. And this is not between the parent and subsidiary companies. All the parties are different. Then comes the price variation, where you change the invoice price in order to compensate for the future price fluctuation, exchange rate fluctuation. So instead of quoting $2 for something that you are selling, let's say you are selling this remote to some party in America, and instead of quoting $2, you will quote $2.5. So you have varied the prices. Why? Because you think that will help you to compensate for the loss in exchange rate fluctuation. So that is price variation, again internal hedging. Asset and liability management, just forget about it, you can read it. Then comes the external hedging. External hedging has two parts: derivatives and money market hedge. Let's first talk about derivatives. Forward contract is the simplest form in external hedging. Derivatives, you take a forward contract and then honor the contract at due date. So if you are agreeing to sell or buy the foreign currency at 50 rupees, you do the transaction at maturity and the hedging is done. Why? Because once you enter into a forward contract, futures contract, options or swap, you are not worried about the future spot rate, because in all these cases you fix the spot rate today itself. There are some variation in futures. In futures there are some steps that you need to understand. I will take you there. What are those steps that we discussed in futures? I think we have written it somewhere else. Okay, I will write it here. If you remember, in futures there were few steps. Currency futures. Yeah. So I'm repeating this. If we want to sell underlying asset, then start by selling futures. If we want to buy underlying asset, then start by buying futures. And underlying asset is decided by what is quoted by the stock exchange. You can take the lot size to interpret that. It is not I want to sell dollar, that means dollar is the underlying asset. No, underlying asset of futures is decided by the stock exchange, not you. So find out what is the asset. Now, first decide whether you want to buy or sell futures. If you want to buy underlying asset after 3 months, buy futures. If you want to sell underlying asset after 3 months, sell futures. Simple. Once you decide whether you want to buy or sell futures, then calculate how many number of contracts you want to buy or sell. So number of contracts will be calculated based on lot size. Then comes to initial margin. So if 50,000 is payable, let's say 50,000 rupees is payable as an initial margin on one contract, and you decide to go for 10 contracts. Let's take an example. Decided to buy futures, then 10 lots, then 50 into 10 lots, that becomes 5 lakh rupees is the exchange margin that you will have to pay. 50,000 on one lot. There are 10 lots that you are buying. So 5 lakh rupees exchange margin you pay. How are you going to pay? You borrow that 5 lakh rupees and then pay it to the stock exchange. So at the end of 6 months or 3 months, you will be paying this much amount plus interest to the bank. Okay, then at expiry, what will happen? See, you will settle the futures in cash by taking the opposite position. You had a buy position, you settle it with sell position. So sell minus buy will be your profit or loss. So this will be your profit or loss in futures. Then the real cash flow that you will receive from your customer, or you will pay to the customer, you will convert that gain or loss. Okay. If that gain or loss in futures is in foreign currency, then we have added one more step here to convert that gain or loss in foreign currency into home currency at spot rate. So this is one of the same step. If this gain or loss is already in your home currency, then fifth step is not required. The next step is exporter will sell the foreign currency receivable and importer will buy the foreign currency receivable at spot rate. So this spot rate and this spot rate is same. So whatever is receivable payable, you do it. Futures has nothing to do with your export transaction or import transaction. You have to settle that at spot rate. So this, the total of this 6th and 5th. So total of 5th and 6th will be the net outflow or inflow of futures option. One more thing which we didn't discuss at that time is interest along with principal will be repaid. So this interest will also become the cash inflow and outflow. 5, 6 and 8 interest. Understood? Let's take one example that we took in one of the question, I think. See, futures contract. One of the question we said that underlying asset is GBP and we want to sell euro by GBP. So GBP we want to buy, hence buy futures. Then we calculated number of contract. It came to 54.42. We rounded it off to 54 because contracts are not dealt in decimals. Then we calculated profit or loss in futures. Margin was not there in this question. That's why margin is not taken. Then we calculated profit and loss, exports receivable, and total comes to 3401,305. Similarly, now comes to option contract. Option contract. All the steps are very similar to futures. In option, first you decide what is the underlying asset. If you want to buy underlying asset, buy call. If you want to sell underlying asset, buy put. In both the option you are buying now. Option is buying. But whether to buy call or put, that is the first thing we need to decide. After we have decided whether to buy or call or put, then we need to calculate the premium. We will borrow some money from the bank and pay the premium so that we can open a position in option. Then what will happen at maturity? We will compare the spot price with the strike price. And then we will decide whether what will be the payoff in every situation. If the payoff is there, see, if the payoff is there, we will exercise or we do not exercise. Accordingly, we will calculate the profit or loss in option. If we exercise, there will be some profit. If we do not exercise, there will be no profit. Loss will not be there in any case here. In option, loss is not there. Then, so we have settled step 3 by, we have settled option contract in cash in step 3. In step 4, we will buy or sell foreign currency which is payable or receivable to the seller or customer at spot rate. So buy foreign currency payable to the seller, sell foreign currency receivable by the customer at spot rate. Now, step 5, repayment of borrowing for premium along with interest. You borrowed some amount here na, to pay the premium. Now you will repay it. So step 3 is the option settlement, step 4 is the customer contract settlement, and then 5 is the repayment. Step 3, 4, 5, the total of this will be the total payable or receivable in option contract. That's it. Then comes the swap. If you remember, swapping has no rules to it. The only thing that you need to remember is you are taking something and giving something. It depends upon the question how we are going to solve it. And the last part was money market hedge. If you remember the steps in money market, it was if we have a foreign currency payable, it depends upon two scenario. Do we have foreign currency payable? If we have a payable, we used to create foreign currency receivable. So in order to create receivable, we need to deposit money today, na? We will receive at expiry only when we will pay something to them today. So we used to calculate deposit present value of foreign currency receivable. So in order to deposit that, first we used to buy this foreign currency, na? Because we are in our own country. How are we going to deposit foreign currency in some other country? So buy foreign currency at spot. So let's say $1 lakh is there. $1 lakh has to be created, and for that $90,000 has to be deposited. So we need to buy $90,000 today. We will buy the dollars, deposit this dollar, it will become receivable, which will be settled with payable. Then in order to buy the dollars, we need to borrow home currency to buy foreign currency. So let's say we borrowed around 10 lakh rupees or 1 crore rupees to borrow $90,000 to buy $90,000. So we borrowed this much amount. By paying this much amount, we bought $90,000, then deposited $90,000 today. So for at 0 time, this is first step. At 0 time, this is second step. At 0 time, this is third step. Then after 6 months, this is going to be the first step, which will be settled with this step. Receivable 90,000 along with interest will become 1 lakh, and it will be settled. And in India, so after 6 months, this is going to be 3 step. We are going to settle this along with interest. So let's say this is going to be 11 crore. That's it. So what is the purpose of money market hedging? The purpose of money market hedging is to create a situation in such a manner that no cash flow is transferring from one country to another country. There should be no cash flow from one country to another country. If there is no cash flow from one country to another country, it doesn't matter what is the exchange rate on that date, because we are not required to buy or sell foreign currency. If you do not buy or sell foreign currency at expiry, then there is no exchange rate risk. Do you understand that? In the same way, we used to deal with the situation of foreign currency receivable. So if you have a foreign currency receivable, you used to create foreign currency payable. Payable means payable. After 3 months, you will pay them. How come? In which situation after 3 months or 6 months you will have a payable? If today you have received some money. So what you are going to do, you will borrow present value of payable. So let's say this is 1 lakh. This is 1 lakh. So today you borrow $90,000 from them. Tomorrow you will have a payable with interest. Once you have borrowed dollars to India, you will sell that dollar at spot and receive $90,000. Once you have sold that dollar, you will get rupees, and then you will invest that rupees for, let's say, 3 months. Whatever it is, 10 crore rupees or 1 crore rupees. So the steps are like this. At 0 point you borrowed, at 0 point then you sold that currency, and at 0 point you invested. After 3 months, what will happen? You will have a receivable which you will settle with this. After 3 months, second step is payable, and then after 3 months the third step will be investment proceeds that you will receive in India. So this is received in India, this is paid in US itself. We are not transferring any money to America. America is not also transferring any money to India. So no exchange rate fluctuation. This is called as money market hedge. Let me take you to those steps. See, if you have a foreign currency liability, create a foreign currency asset in case of foreign currency liability. See, what does it says? The main objective is to arrange the transaction in such a manner that on due date there should not be any flow of cash from one country to another country. So create an asset. In order to create an asset, determine the present value by deposit rate, because you will deposit. Then borrow home currency equivalent to the value of foreign currency liability. Convert the borrowed home currency in foreign currency at spot rate. Invest this foreign currency at foreign currency deposit rate. On maturity, it will become exactly equal to the liability which will be settled with the foreign currency liability. And on the other hand, in India, you will have to make a payment of borrowed amount along with the interest. Only these two things will happen in their own country. America to America, India to India. No cash flow is transferring from one country to another country, and say opposite is with the foreign currency assets. So this was all about hedging, and the last part is delivery, cancellation, extension of forward contracts. Few things that you have to remember in this is there are 9 steps. Let's go to our notes in this case. You remember there are 9 different situations. This is fresh. 9 different situations. The easiest one is early cancellation, cancellation on due date, early extension, and extension on due date. So in the first part we took this. In all the 4 parts you understand that we will cancel the old contract. In this though we are already cancelling, but in these two also before extending we need to cancel the old contracts. And one thing that you need to remember. Let's first take cancellation on early date and cancellation on due date. The only points that we need to remember in case of cancellation is to cancel the original contract, take the opposite position. If you have buy forward, take the sell forward. If you have sell forward, take the buy forward. Buy, sell, buy. Original and cancellation contract should expire on the same date. So I'm taking some example. Let's say this is the timeline and this is due date. Original contract is forward, sell, and you want to cancel. On due date. This contract is expiring today itself, so the new cancellation contract should also expire today. That means spot, and sell will be cancelled with buy. Simple. But if you want to cancel on this date, that means sell will be cancelled with buy. First of all, this contract is expiring 1 month from today. Okay, so you will also take 1 month forward buy. Simple. You will also take 1 month forward buy in order to cancel. Now, in order to cancel this, if you are cancelling here, take forward buy. If you are cancelling on due date, take spot buy. Similar is with forward buy. If you have a forward buy, if you are cancelling before due date, you will take forward sell, or if you are cancelling on due date, you will take spot sell. Simple transaction. How you want to cancel, it depends upon you. In case of extension, the same thing is applicable. The only additional part is In case of extension, the only additional part is you will take new contract. Because you want to extend, that means customer wants to honor, customer wants the delivery after some date. And let's take for example, he wants a delivery of 1 month after the due date. Okay, in this case same thing will happen, plus if you are cancelling on spot, 1 month is left for the delivery, so here you will take 1 month forward, 1 month forward sell original part. It was selling, we were selling, now also we will sell, but after 1 month. So we cancelled sell with buy and entered into a new sell contract, which is going to expire 1 month from today. But if we cancel before due date, it will be 2 month forward sell, because from this date the new contract, the new delivery date is 2 months away, so we will take 2 months forward buy. If we take it here, it will be 3 months forward buy, okay, because the delivery date is that. In case of this, same thing will happen. If we take a new contract, it will be 2 months forward buy, it will be 1 month forward sell. In extension, this is the additional thing which I have written in red. Otherwise cancellation part is same in all the 4. So what did I say? Only points to remember in cancellation is these 2. Now let's come to this part, 7 and 8. That means early extension and due date extension. Extension on due date. In this case, cancel the original contract by entering into opposite contract expiring on the same date. This is what we did in the previous part also. Now enter into a new forward buy or sell contract for the balance period of delivery. From that date on which you are cancelling, calculate how much time is left for the delivery in case of new contract, and for that period you need to take forward buy or sell. And this part is very easy, my friend. 4, 5, 7, 8. The major issue comes in early delivery. In case of early delivery, it is up to the bank whether they accept the early delivery or not. But in normal case, bank will accept the early delivery. If it happens, see few things that we need to read. If the early delivery happens, what will be the points? Sometimes because of some unexpected situation, exporter who is going to sell the currency to bank, importer who is going to buy the currency from bank may request early delivery of foreign currency. According to FedI guidelines, bank may or may not accept customer request. In general case, they will. In general, bank will accept it and hence sell foreign currency to the importer or buy foreign currency from the exporter. On early date at an agreed rate, they will do that. Since bank was not prepared for early delivery, it will cover this transaction at spot in interbank market. At an early date, they will sell or buy. Now, this will result into some profit or loss, and profit will become payable to the customer, loss will become receivable from the customer. Now, profit or loss will also be treated as early cash inflow or outflow of funds on which the bank will pay interest or recover interest from the customer. Okay, we agreed that there is a profit or loss to the bank, but this profit or loss happened 1 month before the due date, and that's why it will be considered as inflow of funds or outlay of funds on which the bank will recover or pay 1 month's interest. Because of the transaction on early date, original cover contract will remain open, which is due on maturity. This was supposed to be cancelled with customer contract, but now bank will take the new forward cover for the remaining maturity to cancel the old forward cover. I will explain this, just give me a minute. On maturity, this old contract will be cancelled with the new cover contract, and it will again lead to profit or loss to the bank, which will be payable or receivable by the bank. This is the second situation where the bank is dealing with the profit or loss, recoverable or payable. Third thing, along with A and B, bank will also recover the profit which would have happened on the original contract, difference between the agreed rate and cover rate. Now, in total, this is the most important part. In total, apart from the interest on outflow or inflow of funds, bank will recover or pay. What is the nature? Profit or loss on early date, profit or loss on maturity date, and profit on original contract. Now, what is the profit or loss on early date? The agreed rate at which the customer took the delivery and the spot rate. On maturity, the old cover contract and the new cover rate, the difference between these two. And profit on original contract is the difference between the customer rate and the original cover rate. Ultimately, you can avoid these three transactions if you just take the difference between spot rate on early date and new cover rate on maturity. I will explain this. This is called as swap loss or gain. In other words, this is the difference between two new contracts entered into in order to cancel the two old contracts. Remember this. Let's say the original contract was at 65.40 early date. Did I write it somewhere? I am pretty sure that you understand that diagram. Even if you don't, let's focus on this is an example of early date and this is a due date, okay? And early date means this is an early date. Now this is going to be agreed rate with the customer. In order, this was supposed to happen on that date, but now the cash flow is happening on this date. For this agreed rate, bank had taken cover, and we will call it as old cover rate. This cover contract was there to cover this contract, and both of them should have happened at this point only, but because of the customer it happened here, and that's why what will happen now, this agreed rate, whatever the buy sell is, will be settled with a spot rate on this date. And since this old contract cover is open, it will be cancelled by opposite position new cover with a new cover. This contract will be taken at this point. This cover rate will be taken at this point. So it will be 1 month forward buy or 1 month forward sell. So basically, because of the early delivery, bank will suffer some loss, which will be the difference between these two rates, loss or profit. Okay. So this will be some profit or loss. Again, in order to cover that, because of the customer, bank had to cover this with the new cover rate on this date itself. So there will be some profit or loss in this case also. In this case also there will be some profit or loss. So there will be profit or loss in this case. And originally, if everything would have happened properly, there would have been some profit to the bank, which is a difference between agreed rate and the cover rate. So can you see profit? Now what I want to say is bank will recover or pay all these three things from the customer, and we can avoid these calculations if we just take a difference between these two new rates. This is called as swap loss or gain. That's it. You take the difference between these two, and this small difference will cover the profit here, the profit or loss here, and the profit or loss there. it covers everything. Okay, so you can take this. So that is how we calculate the swap loss. So swap loss is calculated in as a difference between this rate and the new cover rate, and interest is calculated on this amount. This is a profit or loss also, but it is happening 1 month before. So we will also calculate the interest for that 1 month on this amount. So that will be recovered. Loss is also recovered in here, and interest is also recovered on this point here. Why we are not calculating interest on that profit and loss? You may ask this question, because this is happening on due date. Why not on profit? This is also happening on due date. It was originally supposed to happen on due date. That's it. This is a profit foregone. It's as good as loss recoverable. Okay, so this is what the early delivery means. I'm coming back to the point. So in early delivery, what happens? First thing, you pay or sell, you pay or receive as per agreed rate. First thing. Second, interest on outflow or inflow of the funds. If there is outflow, recover it. Inflow, pay it to the customer. Then swap loss, recover from the customer, or gain, pay to the customer. Then comes the late delivery, late cancellation, and late extension. In case of late delivery, cancellation and extension, automatic cancellation rules applies. So if the customer does not come on the due date, from that date, bank will still wait for 15 days. That means the contract is still open. However, the old rate agreed between the customer and bank is no more applicable, and it has to be cancelled. I will take you to that point. In any of these situations, original contract will be automatically cancelled on the spot rate of the date on which the customer requests the bank to cancel, to deliver, or execute, or extend. Whatever he requests, delivery, cancellation, or extension, whenever he is going to come to the bank on that day's rate, or the 15th day after the due date, whichever is earlier. So you might not have understood this, so let me explain. Let's say, for example, this is the timeline, and this is the due date, and this is 15th day after the due date. So if the customer comes here before 15th day, at this date's spot rate, the cancellation will happen. If the customer comes here, this date's spot rate, cancellation will happen. If the customer comes, let's say, on 15th day, then this date's rate. If the customer comes on this date, means after 15th day, still this dates, means 15th day's rate will be applicable for cancellation. Now he can come anytime. We have already cancelled the contract on 15th day. So he has an option to come before 15th day. So at that time we will apply that day's rate for cancellation of the old contract. But if he comes after 15th day, then we will apply this rate only. We would have already applied on 15th day. It will automatically cancel. The profit or loss will automatically be calculated. Now it is only a matter of recovering from the customer. Okay. One thing in late cancellation, delivery, and extension, you need to understand. In this process of late delivery, late cancellation, or late extension, if any gain is there to the bank, it will not be shared with the customer, as these cases are treated as a default by the customer. In early delivery, gain was shared with the customer. In early cancellation, due date cancellation, early extension, due date extension, everything, we used to share gain with the customer. But in case of late cancellation, delivery, and extension, no gain will be shared with the customer, and if there is a loss, it will be recovered from the customer. Swap loss on interest on outlay of funds, if any, will be recovered from the customer in usual manner, irrespective of the fact that bank has not entered into any swap transaction. This is the important thing. It doesn't matter if the bank is entering into a swap transaction or not, still the loss of swap will be recovered. We will assume that bank has entered into a transaction even if it is not entering the swap transaction, and this is a guideline by FedI. So even if in the question, in case of late delivery, late cancellation or late extension, the statement related to swap is not written, still you will assume the swap transaction and calculate the loss. This is the meaning. So this is the difference between early delivery swap loss calculations and late delivery swap loss calculation. In case of early delivery, early two rates were used to calculate the interest. In case of late delivery, the rates on due date will be used to calculate the interest. But the difference is, in case here it was the customer rate and here it is the old cover contract rate, because these are the two transactions happening first, the due date transaction. So interest will be calculated on this until the date when the customer comes to the bank. So if the customer is coming after 10 days, we will apply an interest, recover an interest for 10 days. That's it. Apart from this, the swap loss calculation is similar. See the blue line, the difference between these two rates and the difference between the two new rates. Please understand, this forward buy rate means a swap transaction. It may not have been entered by the bank. If it is not entered by the bank, we will take the closest possible forward buy. Closest, why closest? Because this contract is anyhow is getting expired after 15 days. So why the bank will take 2 months forward in that case? Okay. Swap loss calculation is same. Spot rate, which was used to cancel the cover contract, and a new forward buy rate which was cancelled, which was used to cancel the customer contract. Instead of buying, we will say forward rate only. If this is a buy, this will be sell. If this is a sell, this will be buy. So buy, sell, buy. It will always be like that. So if this is buy, this will be sell, this is sell, this is buy. Okay. Or if this is sell, this is buy, this is buy, this is sell. It will always be like cross. One thing. Now, these two are original contracts. These two are original contracts. Okay, these two are new contract and these two are new contract. Why these two contracts has been taken? In order to cancel the old contract. So swap loss or gain is calculated between the two new contracts difference. Okay, in early delivery also, in case of late delivery also. And interest is calculated as a difference between these two transactions. Here also as a difference between these two transactions. What is the difference in these two is, here it is the customer rate in case of early delivery. Here it is the cover contract in case of late delivery or cancellation, because customer rate is shifted here. And in case of late delivery or cancellation or extension, this customer rate is cancelled with the spot rate. You can see spot rate or 15th days rate there. So 5th rate is also incorporated here. All in all, you need to understand that in case of early, swap loss or gain can be there, interest on outflow or inflow can be there. These are the two things recovered or paid to the customer. But in case of late, swap loss only, not gain, interest outlay only, not inflow, and cancellation charges are also there to be recovered from the customer. So I hope we have finished this work of early cancellation, due date cancellation and late cancellation. Let's come to the chart, and now is the time to discuss about Nostro, Vostro and Loro account. Nostro account is our account, or you can say my account in your bank. vostro is your account in my bank or our bank, and loro account is your account with their bank. So let's make it clear. Let's take three banks. This is Bank of America, SBI Bank and ICICI Bank. And let's say Bank of America has an account here. In Bank of America, there is one account. And this account is of SBI. SBI opened an account here. First thing you need to understand is this account can be nostro, vostro and loro. So nostro, vostro, loro are not three different accounts. Are the names depending upon which party is using this account. So as for SBI, you can see this account is of SBI. So SBI will say this is my account in your bank. So that's why it's a nostro for me. Bank of America will say this is your account in my bank. It's a vostro for Bank of America. And for ICICI, the account is not of ICICI, the bank is also not ICICI. So ICICI will say this is your account, means SBI, in their bank, means Bank of America. So it's a loro for ICICI account. Same account can be nostro, vostro and loro. It depends upon the party from whose angle you are dealing this. Okay. Yeah, strategies for exposure management. If you remember, low risk, low reward. When do you say it has a low risk, low reward? I will take you to that note in our book. See, low risk, low reward. Whenever you say low risk, low reward, that means when you immediately hedge the foreign exchange exposure and you do not wait for the favorable rates and you do not spend time in searching for the favorable forward contract rate. So it is favorable or not favorable, you will enter into hedging. That means you will save time. This is low risk. That means you are not taking any kind of risk. Immediately you take the forward contract. Let's say today you sold some goods to the customer. You will not even wait for a day and you will take a forward contract for that in order to hedge. So that means you are too conservative and you are not thinking about it. So this is low risky, but you are dealing into forward contract even if the rates are unfavorable. That means low reward. Here the situation is better. Here you only enter into a forward contract when the rates are attractive and you keep the position open when the rates are unfavorable. So this is low risk but reasonable reward. In this case, high risk and low reward. In this case, you totally ignore every sale or buy. You sold the customer and now you are doing nothing. You purchased from a vendor in America and you are doing nothing. So you're totally keeping the position or exposures unhedged, ignoring, waiting for the spot date. That means you are taking a lot of risk and the reward will be very low. But in this case, what happens is the risk is high. In this case, you continuously enter into forward contracts, cancellation, extension. You trade actively here in order to earn some profit apart from the normal transaction. So you make it a separate business. That is high reward, but high risky at the same time. This is all speculation. If the speculation happens, it is high risk, high reward. So these are the 4 strategies of exposure management. So this is how we have completed Forex. I don't think so anything is left. ISO code, you remember. ISO code is a standardized form of presenting every currency or country's currency. ISO 4217 is the international standard which describes 3-letter codes, which is also known as a currency code. So some important currency codes I have quoted here. For India, it is INR. For America, it is USD, Japanese yen, JPY. You can see first 2 letters are represents the country. India, IN, America, United States, Japan, JP, Great Britain, Great GB, Canada, CA, and this is Switzerland, Swiss franc, okay, so CHF, AU, Australian dollar, Australia, SG, Singapore, EU, Euro, okay. So, and the last digit last letter represents the currency. Rupee R, dollar D, yen Y, pound P, dollar D, F franc, dollar D, R euro. So this is how the currencies are there. This is how we have finished the foreign exchange and risk management chapter revision. In the next chapter, I hope this has helped you and this will help you a lot while revising. And I expected you to revise this entire video at 1.5 speed so that you can cover up in again less time. That's it. In the next lecture, we are going to start a new chapter, that is international financial management. Bye bye from my side.